Hi guys, so we are talking about the technique financial analysis as it is outlined in the BABOK guide. So sit tight, let's have a look at some of these financial concepts and calculations. It isn't too scary at all, so I look forward to sharing it with you. So let me share my screen and we can run through these important concepts. Okay. That's fantastic. So there is a technique referred to in the BABOK guide as financial analysis, although it consists of a number of calculations that you need to understand and understand where it comes into play. So let's have a look. Financial analysis is basically used to understand the financial aspects of an investment, a solution, or a solution approach. So let's see, what is financial analysis? So this is the assessment of the expected financial viability, stability, and benefit realization of an investment option. This includes the total cost of the change, as well as the ongoing costs and benefits of supporting and using the solution. So keep in mind, just for a bit of context, before any project comes to life within your organization, somebody needs to work out whether this is a good idea or not. And from a financial perspective, there are certain ratios and certain calculations that needs to be made or done in order to work out whether it's a feasible and financially good idea to proceed with a particular initiative. So this is all this is about. Do we invest or don't we invest, and what benefits can we expect from a financial perspective? So let's dive a bit deeper into what is financial analysis. So a business analyst uses financial analysis to make recommendations by comparing more than one solution option against another. So the following is considered: the initial cost and time frame in which costs are incurred, expected financial benefits and the time frame in which they will be incurred, ongoing costs of using the solution and supporting the solution, risks associated with the change initiative, and ongoing risks to business value of using the solution. So let's see a bit more. How do we do this? So there are a number of elements within this technique that you need to understand. So we'll look at the cost of change. We'll look at total cost of ownership, or TCO, what that means. Value realization. We'll have a look at cost-benefit analysis. And then we'll dive a bit deeper into the financial calculations. But let's first start with the concepts around the cost of the change. So keep in mind, when we talk about the change here, it's about the solution we're planning to implement, or the initial initiative we're planning to embark on, or the transformation. So this is what the cost of the change looks like. So this includes the expected cost of building or acquiring a new solution, the expected cost of transitioning the enterprise from the current state, so how things are today, to the future state. And this could include cost of changing the equipment, changing software, changing facilities, staff, or any other resource from the current state to the future state. It also includes buying out existing contracts, subsidies, penalties, converting of data, training people, communication about the change, and managing the rollout. So essentially, the cost of the change is every aspect of that change in terms of what it will cost to move from the current state to the future state. So element 2, here we're looking at the total cost of ownership. So what does TCO refer to? This is basically the costs associated with acquiring the solution, the cost of using that solution, and the cost of supporting that solution into the foreseeable future. Now, to use the TCO as a calculation or as an actual value, some companies would define what does the foreseeable future mean. And they tend to time box a period of time. So they might say foreseeable future for any solution they ever acquire is 3 years, 4 years, or 5 years, so that they can quantify the actual costs. Okay, so now let's look at element 3. This is about value realization. So what does this refer to? This is the expected value to be realized over a period of time. So it's expressed as an annual value or a cumulative value over a specified period of time. So we may say, yes, we know what it costs to do the change, but at which point do we start to see some value? At which point do we start to get some business benefit back? So this is what this is all about. Now, element 4, we're looking at the cost-benefit analysis. So this is important to understand the principle of this. It's about the prediction of the expected total benefits minus the expected total costs that results in a net benefit, which is effectively the business value. So this time period of a cost-benefit analysis should look far enough into the future to a time when the solution is in full use. So a cost-benefit analysis is fundamental in the sense that it tells us what it would cost for the next period of time, which we may determine is 5 years. What's the cost going to be, and what's the total financial benefit that we'll see? And then to go and compare the difference between those two figures to see at which point do we actually start to see a financial gain. And this is why they say it's important to look far enough into the future to a time when people are fully using the new system. So there's no point in doing a cost benefit only for the period of time before the system is fully live. So let's have a look at the final element. This is the financial calculations. So I would like us to run through these different concepts and make sure that you can see what it is used for, but also understand what the calculations would be. So the first one we'll look at is return on investment. Then we'll look at the discount rate, the present value, the net present value, the internal rate of return, and the payback period. Now, just a note, I know that we don't all enjoy financial calculations, and we don't always think we are necessarily into calculations like this, but please do pay some attention if you are planning to do the CBAP exams or the CCBA exams. Make sure that you can do these calculations and that you understand what they mean from an investment perspective. Okay, let's jump into it. So return on investment. This is expressed as a percentage of the net benefits divided by the cost of the change. So the formula to calculate the ROI is as follows. So the ROI equals total benefits minus cost of investment divided by the cost of investment, multiplied by 100 because it's a rate. So the alternative with the highest ROI is the alternative that provides a greater overall return relative to the amount of money that we invested. So this is an important calculation to do, to be able to do. So the next one, the discount rate. So this is the assumed interest rate used in present value calculations. This value is determined by the organization and is made available for any present value calculations. So the present value calculates the present day value of expected benefits. So the present value is expressed in currency format and it doesn't take the cost of the investment into account. You calculate the present value by taking the sum of the net benefits in a period divided by 1 plus the discount rate for that period for all of the periods in the cost-benefit analysis. So make sure that you read this formula well, and we'll have a look at an example. But let's just first understand what's the net present value then. So the net present value is the present value that we've just calculated minus the cost of the original investment. So the net present value is simply present value minus cost of investment. Now the internal rate of return, or the IRR, this is the interest rate at which an investment breaks even. So this assists in determining whether an investment is worth investing in and can be used to compare different solutions against each other. Now, the calculation for this is it's basically the net present value equals minus 1 times the original investment plus the sum of the net benefit for that period divided by 1 plus the IRR for all periods, where it equals 0. So the IRR I have read up about, and I don't think you will be asked to do this calculation within the exam itself. You may be provided with the internal rate of return, and you may be asked to do other calculations, but I don't believe they'll ask you to calculate this particular ratio, the IRR. All right, so now let's look at what is the payback period. So the payback period shows a projection on the time period that is required to generate enough benefit to cover the original cost of the change, irrespective of the discount rate. Okay? So there's no standard formula for the payback period. It's expressed in years when it is used to calculate. So you can use different ways to work out how long is it going to take for us to start getting our money back for all the money that we've invested, basically. So there's no specific formula to learn. It's just important that you understand what it means. Okay, so let's have a bit of a practical exercise. So the assignment for you here is, I want you to calculate the return on investment, so the ROI, the present value, the PV, and the net present value, the NPV. And the assignment gives you all the information you need to be able to do this. So we've got 4 options, 1, 2, 3, and 4. We have initial investment values for each of those options. Then we have the net benefits for 4 years for each of those options. And we've got a discount rate applicable for every year. So now I'd like you to pause this video and take some paper and try and do the return on investment, the PV and the NPV with this scenario. So pause the video and do this first, because on the next slide, I'm giving you the answers. Great, so I trust you've done the exercise, and I trust that you've managed to find the answers. But you can see for each of those options, the return on investment, the PV and the NPV calculate to be the figures you see down there. Now, just to help you, if you didn't get those particular figures, have a look at the formulas that you needed to apply. For the ROI, very specifically, for every single option, you would have had to take the year 1 benefits, plus year 2 benefits, plus year 3 benefits, plus year 4 benefits, minus the initial investment for that option, divided it by the initial investment, and multiplied then by 100. This will give you the ROI. The present value, you would have had to take year 1 benefits divided by 1 plus 2.1% plus year 2 benefits divided by 1 plus 2.3% plus year 3 benefits divided by 2.5% plus year 4 benefits divided by 1 plus 2.55%. And then the NPV, the net present value, would have simply been the PV minus the initial investment. So I really suggest you have a try to get those answers. These are probably the most popular calculations to learn and to know how they work. They may or may not ask this in the exams, but it's anyway quite a useful set of ratios to be able to apply. Okay, so over to you. I hope this has been a bit more of a brain teaser for you, and I hope you find some value in understanding some of these financial calculations a little bit better. It's really good to master these. What examples have you got of where you may have needed to use these? Perhaps you've been part of a strategy analysis or an investment assessment in the past, or perhaps business cases that you've helped develop. So that would be wonderful if you could share some of your experience. And anything that you know about these particular topics for the exam, please help us out and share your experience. Great, thank you so much, and look forward to see you again in the next video. Thank you.